Good morning, everybody. We are extremely pleased to have so many of you joining our call. We have a lot of topics to discuss, and we were very pleased with so many of you that were able to participate in our Natural Resources Day that we had actually last week. Now, just to inform you about our homepage in the future, so if you're not able to join an event from us, if you just enter our normal homepage, in the main home button, you find actually the news, you find always the videos, as well as the presentation. So all the videos from the last Natural Resources Day, if you click on here, you find all the videos. And like that, I think you should be in a very good position to actually follow things, even if once in a while you're on holiday, that you should be, and then miss one of our events, and then you can easily catch up with looking at the recorded version of that. With that, we would like to start now with the formal presentation. Marcos, the floor is yours.
Okay, thank you, Alex. Good morning, everybody. Thanks a lot for joining the call. We're going to give the update for the first half of the year, which is maybe a bit late, but we'll try to also comment a little bit about the third quarter. And the plan is, as usual, a little bit top-down. So the first point is recession. Is there a recession? Is going to be a recession? Well, we don't know, and nobody knows. And it's important to understand that it's very difficult or impossible to be correct on this is going to happen or not, because it is very dynamic. So if we start from the slide number 3, you can see that nothing really has changed in our opinion. You know very well that we don't invest following the macro, but we have a base case scenario, which is this one. US and Europe are continuing to slow growth, while China is seeing an economic recovery. So this has been the case for the whole year. Out of the 5 indicators we follow, 4 of them are still in negative. So PMIs or industrial production negative, so going down. Rates still moving up. Downwards earnings revision continue and probably will get a bit worse in the second half of the year. And global liquidity is going down. So these 4 indicators suggest cautiousness. And only China is in positive delta, but the recovery, as you well know and better than me, is very, very slow because they have some structural problems that we'll comment later. So this is very normal end of the cycle. We don't see really major structural imbalances or bubbles. There's a couple of things that worry us, which is the huge and fast rise in rates and their impact in fixed income, like we saw with the SVB Bank in the US or similar issues. And the other problem that really is difficult to understand well is the challenges in the Chinese economy and in property. So, you know, so far, I would only highlight one thing is that we were a bit wrong with the strength of the economy globally due to the services sector. And we think that this is based on the base effect from COVID-19, so comps, and also the household savings and fiscal impulse in many countries. So this is basically what we see. That the world is slowing down. And I wanted to add here a sentence from Buffett and Munger, which say that a depressed stock market is likely to present us with significant advantages. And it's what we are doing. Slide number 4, I will accelerate a little bit. Weak manufacturing orders. If you see the lines, US is black and, Euro is black and the US is green. So you see both at around 40 in terms of manufacturing and PMI. This means that the industrial world is slowing down. Just China and Asia ex-China are doing better. In slide number 5, you can see what we already said in the past few quarters, inflation is coming down. So no comments here. If you see the estimates from Morgan Stanley, but this is consensus. Inflation by the end of next year will be roughly around between 2 and 3%, which is a kind of normalized inflation. So the high inflation time is probably over, and also the higher rates and the slowdown of the economies are going to keep pushing this inflation down. Final comment in the next slide on China. You see that the property sector has stabilized on a very low levels. Here you can see that the completions are still up, but this is a late indicator. Starts are still in negative. Looks like the sector is finding a floor, but as you well know, the recovery in China is being very slow and slower than we expected. Anyway, we still have a 5% growth GDP terms this year, and probably the recovery will get reinforced with all the measures that the government is adopting. So in the next slide, I wanted to highlight in slide number 7, something which is very interesting is that the tech sector is back to the highs. Basically, is the big five companies, the FANGs, and these guys, they account for 25% of the SPX. So when we look at the Standard & Poor's making a 16-17% year to date in dollars, most of that is the tech sector. In our opinion, this is quite normal. We saw that in the bubble in 2000. We saw that in 2008. So there's technical rebounds when the sector is normalizing, and valuations now are really, really high in the tech sector. A difference with the bubble, with the tech bubble in 2000, is that the business model of the big funds are strong models. So it's more a matter of valuation. Nobody's really questioning the business models as we did in the tech bubble. So finally, conclusion for me, cautiousness, patience. We are managing the funds on a conservative way. We build some cash, and also we've moved a little bit more to categories 1 and 2 in order to be more resilient, just in case the slowdown is taken back by the market. 4 out of 5 leading indicators negative, so relax. Slowdown is not over. We think that the trough will be by the year end on normal conditions, but we don't care, and this is the main message. So the classic and the natural resources are built to withstand any recession or a scenario. So there's no problem. If there is a recession, we will buy more. If there's no recession, we'll make our target. So, and we find a lot of things. So energy transition, supply chains, infrastructures, CapEx cycle. So there's a lot of things where we can invest if a recession comes and the markets get cheaper. So for me, that's the final introduction. I hand over to Carlos.
Hello, good morning. I'm going to, in the Natural Resources Day, which we had, and where Alex showed you that you can take a look at the videos. We talked about peak oil. Peak oil became a very fashionable topic in the previous upcycle of oil in 2006-07. Meaning, of course, peak oil supply. There wouldn't be enough oil. Then the big crisis came in 2008, the price of oil dropped, but then it recovered all of it, actually. But then shale oil came, and then that lowered the price of oil significantly for many years. As you all remember, it even became negative at some point, but then it's been going up. So the talk of peak oil, peak supply in oil has been changing the narrative of investors by peak demand for oil. Now, this is the chart of oil consumption. Many people, particularly the International Energy Agency, said that 2019 had been the peak. Now, we know, of course, in the next slide that was not really the case. And in fact, this is up to 2022. If we added, because I only wanted to put the data that's already in there, but if we put 2023, which we already pretty much know, it's well above 2019. So there was no peak supply, but there was no peak demand either. Now the question is, how is this going to last? You know, energy companies, we keep saying it, you keep hearing it, are very cheap. Now, why are they very cheap? They're very cheap for a very simple reason. You know very well the value of a company is the discounted cash flows in the future, the current value of the discounted cash flow. Now, if you think that oil is going to stop being bought, being used in 10 years' time, obviously you would pay very little for an oil company, because in 10 years' time you would have no business. If conversely you think, now they sell at a very low multiple, because people see no future there. But if oil keeps being used, well, then they're an extremely good business opportunity, because the numbers would be very wrong. Now let's try to see what we can say about long-term future. We had the International Energy Agency again say that the fossil fuels would peak by 2030. Well, they said all kinds of things. They're the same guys who said that, we had already peaked oil demand 3 years ago, and it is completely wrong. So let's take a look at it now. The part of oil that comes to everybody's mind when we talk about oil usage, and the reason why people think it is probably going out of business is because electric vehicles. There's substitution. Oil, contrary to most other energy sources, it is used for transportation, and there you cannot substitute easy. If you are making electricity, you can use hydro if you have mountains, or nuclear if you have a nuclear reactor, or coal, or gas, or even solar. I mean, at the end of the day, the end product is the same. So there's electricity. So those things can be substituted. Well, so far, until now, you cannot put coal or gas or nuclear or hydro in your car unless you make it electric. If you make it electric, you could start using all those things. So you make oil in a way substitutable for the first time. Seriously. Now, and that's what leads people to think, yeah, if everybody buys an electric vehicle, we don't need more oil. Okay, let's take a look at that one. First, let's take a look at penetration of electric vehicles. And now there is a country that is worth looking at, which is Norway. Now, Norway is, if you're talking about energy transition, you could say that Norway is a country which has already transitioned. Practically all the cars now, this data are a little bit old. If you go to today's data, it's almost all of it. New cars being sold are electric. That's because the government has made a huge push with not only subsidies like everywhere, but for instance, there are many places you can only park. You don't pay motorway tolls. There are many things that you can only do with an electric car. So people obviously buy an electric car. Now in the country, it's really clean because unlike China, which powers electric cars with coal-fired plants, so we could argue whether you are actually lowering CO2 or not. No, you are not. In Norway, because of the mountains and the snow, even more than Switzerland, all the electricity is hydro, basically all of it is hydro powered. So it's the transition is done. I mean, there's nothing much more these guys can do. All the electric cars, all the cars they buy are electric, and all the electricity is done with hydropower. Now let's take a look in the next slide at the situation. So you see that, as I said, if you go to current data, electric vehicles are 91% already. But then look at oil consumption. It's gone down very, very little. It has gone down. So, and this is the country in the world that has already transitioned. So we have, in a way, it's kind of an experiment. We transition, I mean, the whole world, instead of transitioning the whole world, which is complicated. It's not to take that. We transition a little part of it, and then see what happens to oil consumption. And then you see what happens to oil consumption. These are the facts. Now, why would that be? And will that happen in the rest of the world? You can see in the next slide that the penetration, of course, of car ownership in the rest of the world is not like that of Norway. Many countries in the world have very few cars. And when we think of cars, we always think of our own car, because this is one of the few products which we can discuss in the presentation, which we all own. So it kind of touches us. But of course, most of the cars on the street are trucks. They're not cars, they're trucks. People don't buy them to go skiing. They buy them to eat, to transport food from the fields to the markets. That is not optional. And many countries still don't have enough of those, so they can have a normal economy. So you go to the next slide, and what I've tried to do here is show, there are like 1 billion cars. I mean, these are very rough numbers. In fact, nobody knows how many cars are there in the world. I've seen numbers that go from 1 billion to 1.4 billion. It's quite a difference. But anyway, you take whatever you want. You take 1 billion. And sales for many years were getting close to 100 billion per year, or 100 million per year. But with the COVID, sales went down sharply because they shut down the factories basically, and now they're recovering. And then you have the penetration of electric vehicles. So what I put in this table, which of course is not a forecast, not even a model, it's just some numbers. You know, if you take the total cars we have now, you take all the cars that get sold every year, and you make a share of those cars electric grow. So more and more electric cars. And then cars last about 25 years, more or less, a bit more. In fact, in the world, you know, they go to poorer places, and the cars that we sell as second-hand in Switzerland, they end up in Eastern Europe, and then when they sell them, they end up in Northern Africa, and then when they sell them, they end up in Central Africa. So anyway, but at the end of the day, the car is there. So let's say that, you know, every year we take 4% of the cars out of the pool. They don't exist anymore. So you have new cars coming in, increasing share of electric cars, and then some cars coming out. So at the end of the year, you have a stock of cars that use gas and some of them electricity. Now, the final line of this chart is how many, if you take these little numbers that I put here, which are fairly conservative for many reasons, is the final stock of non-electric vehicles. So cars which will continue using gasoline, no matter how many cars the Norwegians buy, electric cars. And what you see in this slide is that the number of non-electric cars continues to grow until 2040 something. So it is not going down. The consumption of oil is not going down. But this is cars, and we always think of cars as a thing, but cars only represent, and we can see that in the next slide, only represent part of oil consumption, because trucks are not being electrified because they cannot, as simple as that. I mean, one day somebody may invent something, but they cannot be electrified right now. So diesel is not affected by this substitution. And of course, plastics and the whole organic chemical industry, petrochemical industry, is not affected by substitution of electric cars. So at the end of the day, we're talking about not decreasing, in fact, part of 26% of oil demand. It's the one that is under threat, so to speak, of substitution. And even that part is not going to be going down in absolute terms. And you can see that very starkly in this slide here. What I've put here is like 5 groups of countries, of population. The first one on the left is what they call here the lucky billion. This is us and 1 billion more of us. So Europe, US, Canada, Australia, Japan. We're 1.2, 1.1 billion people. And then you have 4 big clubs. This is not the whole world. You have other countries like Russia and Turkey, and very big. You have China, 1.4 billion, India, 1.4, Southeast Asia, which is Asia without China and India and Japan, another 1.3, and then Africa, 1.3. And the second line is the population that you will have in those places in 2050. Now, this is relatively easy to predict. Of course, there are surprises in demographics, but you know, how many people will be 40 years old in 40 years' time? We know. They've already just been born, so you can just count them. It's relatively easy. So, the third line is all demand, the fourth line, all demand per capita. Now, we burn 13 barrels per person per year. On average, the rich guys. Of course, Americans buy much more than we do. This is an average, but this is the average. The Chinese 3.7, Indians 1.4, Asians 3.2, other Asians, and Africa 1.1. Now, we don't know obviously how those places will develop. That's the future. But what we know is that they would all like to live like us. In fact, many of them would like to live with us because this is, where because we consume 13. I mean, they don't want to come to live in Europe because they like the mountains. They have mountains. They want to come here because our standard of living is very high, and it is very high because we consume a lot of energy. If they grow to some, and there you have a 3%, 5%, 7 point, whatever you want. You can, we don't know what they're going to grow at. Of course, they will grow at different rates. If you take some assumptions of what they're going to grow, then you see what the total demand, because you are growing the economy and the population, particularly in Africa. Economy and the population. If you grow per capita consumption and you grow the number of capita, you get huge increase in consumption. And the last lines in green, well, some in red, are how much would you add to consumption if these people grow at these rates? And the final point is that whatever you do, demand for oil is going to increase sharply, even if it does decrease in Europe in the US, which is doing very gently, as we saw in the case of Norway. So even if the Norwegians buy all electric cars, if we all buy all electric cars, you are going to still have a huge increase of demand for oil. Okay, so that's the last point. Then, when you see, go to the next slide. If you see, the International Energy Agency said the other day that peak oils were going to, fossil fuels, sorry, were going to peak into 2030. I mean, these guys in 2021, so this is 2 years ago, I'm not saying 20 years ago, 2 years ago, said that the peak was 100 in 2019, and it was going down to 75 in 2030. And that's when everybody decided to get out of oil. Well, they said 3 months ago, in May, 4 months ago, that the 2023 would be 103, and by the way, 2028 would not be 75, it would be 108. So a small mistake of 50%. Now, these same guys, they said last week that it will peak by 2030. Now, you can listen to them as much as you want, but you are not going to make good investment decisions based on whatever these guys say. Then we could talk about peak production, but that's for another talk. Okay, Alex, I'll leave you here.
Okay.
Thanks a lot, Carlos. Pass on to Marcos. Yes, please.
Okay, thanks, Alex. Sorry about that. So let's move to the classic in slide 20. I'm going to review a little bit what's going on in the fund. So we are doing fine in 23. As more as you all know, the fund is up 10%, 9-10% in the past few days. Euro 622. Best sectors in the first half: technology, as we all know. Industrials did well with aerospace, defense, and cables. Services also did well, and cement did very well. So we are very pleased with that. And you can see the list of the best stocks: Metso, Autotech, Prysmian, Thales, Compass, Pandora, Sodexo, etc. You can read it. Worst sectors in the first half: salmon and energy. Salmon due to the taxes, basically, and energy has recovered in the third quarter, so it's no longer the underperformer of the first half. You can see the worst stocks, which basically is oil and salmon. So if we move to the next slide, you can see the top 10 holdings that I like to put in every quarter review. And just one thing that they stand out is, aside from the 4Gs that I'm not going to repeat, so good business, good management, good balance sheet, and good price, which is our mantra. I would like to highlight the exposure to defaults. Now it's more than 7% of the fund. We know well the story, that the message here is that we are not going to increase more here because we don't like to have black dogs in the portfolio. Black dog is a stock where you have a deep knowledge, you have a high conviction, and you keep increasing the weight, and then the weight goes to double digit, and then it dominates the portfolio. So this is something that we learn over the years. We will not have a black dog, so Grifols is now a big position and will stay there. If the stock goes up, then it will grow, obviously, but we're not going to buy more. We don't want black dogs here. And final message here is that the release of earnings to June have been overall very good. So no just impact from recession or a slowdown, but this is a late indicator. So we think that in the second half, we will have some downgrades coming. In the next slide, you can see the updated IRR and updated IV, which is now almost 925 euros. So I'm still surprised by the impact that the rebalancing has in the intrinsic value of the fund. So as we rebalance the portfolio and we have new ideas, basically the IV of the fund keeps moving up along the year. And here the message is also a little bit counterintuitive, is that if the market is weak, it has a positive impact in the intrinsic value, because we tend to buy the cheaper things, and then the intrinsic value, which is the real value of the things, move up. So now we are above 900 euros per share. The IRR updated is 14%, which is more or less in the middle of the historical range. We already have 20 years of history, so it's meaningful, which means that basically the portfolio is fairly valued now. Not cheap, not expensive. And yeah, it's. I wanted to highlight in the next slide, you can see what we expect for the next few years. In the slide 23, it's a new chart that we have developed. It's not really rocket science. It's just our target is making 10%. So we are doing a net asset value extrapolation for the next few years at 10%. And this is what the fund should theoretically do in the next few years. You can see that the target for 2023 is 625, and then every year 10%. So you see very clearly the impact of long-term and 10% compounding. So just highlighting a number that is going to be remembered for everybody easily, which is 1,000 euros would be the target of 2028. It is true that this will not happen. We will have good years, we will have bad years, but I'm pretty sure that the end of the line will be very close to this number. So, you know, clear target, 1,000 euros per share, 2028. Let's move to the slide 24, which is the look-through of the funds. You can see that the Classic is now moving to 2024, because this slide is from June. So I already start looking at 2024 multiples. The fund is trading at 11 times earnings versus the MSCI at 16, dividend yield 3.3%, price to book 1.7, when the return is more or less the same as the MSCI. So basically the fund is cheap, and this shows that we buy at a discount. So for us, a discount means protection and also higher expected returns. So, I mean, nothing really new here. In slide 25, I'm going to pass to the investment case, but very fast, because probably most of you know about salmon. But the message here is we are back in a heavy way. Now in the Classic, the sector is up to almost 15%. Why? Because the sector collapsed last year. Why? Because the Norwegian government put a new tax, taking the corporate rate from 25 to more than 50%. So we did our numbers. Then the government has softened a little bit the tax rate. And also we understand that these companies will pass prices, will increase prices to pass this increased tax, which in the end is increased cost. So Leroy stands out, 200,000 tons of salmon 2025. Basically, it's in Norway. The track record is very good. Over the past 20 years, they have built a complete value chain from the egg, so from the initial biology, eggs and smolts, to the final process of the salmon with packed products ready for sale. Track record, as I said, is very good in terms of growth, 10% growth per year for the last 20 years, and return on capital employed of almost 17%, again, in the same period. So it's a good business, it's handled well. And you know that the sector is attractive. If our thesis is correct and these guys can pass through the prices, the increase in taxes, then the summary here is that supply growth is very much constrained. The two largest producers, Norway and Chile, that produce 75% of the salmon in the world, cannot grow more than 3-4% per year. This is at best. And demand at constant prices grows 7-8%. So there's a scarcity in salmon, and this means that the adjustment should come via prices, which is already happening for a decade. So good opportunity for us. We'll make some money. Very briefly, 4Gs, quality assets or quality business, quality management, good balance sheet, and cheap. Look at the price earnings ratio, which is easy to understand, 8 times 2025, including the new taxes. And for us, the intrinsic value is double the current price with an IRR of around 20%. I think this is a kind of clear call for us, and we are hitting hard in the sector again. Finally, we'll move to the natural resources. So the year is being good also. Last year, I think we did 15. This year, another 15 year to date. And this in a moment where everybody is feeling a recession, which normally is not good for commodities. So in the slide 29, I will sum up a little bit. The fund was more or less flat to June, but the third quarter has been very, very good. So the fund is around 150, 155 euros per share. You know that vola here is much higher than for the classic. So we also use this volatility, which is not risk. Remember, vola is not risk. And we rebalance the portfolio quite aggressively from time to time, like with salmon. Best sectors this year has been mines and infrastructures, very good cement this year. And worst sectors, as we said, salmon and energy. You can see the performance in the list in the slide. The message here is that this fund, you know, is valued, or the companies in the fund are really lowly valued. And if you add dividends and share buybacks, most of them are giving double digit. So, you know, we're pretty sure of the value of the fund. The sectors are undervalued, and yes, this is what, because people are fearing a little bit the recession and the Chinese economy. We keep buying at very good prices in this fund. In the slide 30, you can see the composition now. You remember that in 2020, when oil went down to minus $20 for one day, we bought a lot of oil, was more than 50% of the fund. Now it's 1/3. Copper, now if update here is a bit more than this chart, because this is a bit old. Copper is around 1/3 also. And the rest is 15% is salmon, and the rest is split in all these different subsectors that you can see here. We didn't change anything. You can see on the right how we try to add a little bit of value to the natural resources space. In slide 31, the updated numbers. So intrinsic value 224 euros per share updated, IRR 14.3%. All numbers done at mid-cycle, so the upside is much bigger if we go to a peak cycle situation. We are very proud and very happy, and thanks to you all for this increase in assets. So the fund is already growing, 85 million assets under management. You know, we were under 10 million in 2016. So we are proud and happy to see this performance. And we remain extremely positive on the sector. Recession or no recession. Well, if there is a recession, we will buy much cheaper, and automatically the intrinsic value will move up. So generally, the problem is not on demand, it's on supply, and we see clearly a problem in the supply of oil, copper, uranium, salmon, cement, basically, among others, right? So, you know, performance, we are very optimistic on this fund over the long term, and we see doubling in 5-6 years, probably a little bit ahead of the classic. Let's see. Next slide, in slide 32, the same look through of the fund, P 2024 under 10 times, which is a bit better than the Standard & Poor's natural resources, which is at 11 times. But here there's no big differences because the sector is quite homogeneous in terms of earnings expectations. Dividend yield 3.6%, price to book 1.5 times. So multiples are really cheap in the sector. Overall, mid-cycle, from memory, this sector trades at 2 times book. So there's still 25% more here only to go to mid-cycle. And moving to the next slide, I'm going to talk a couple of slides of oil, copper, and salmon. Here, focusing a little bit of short term, you know that we focus always long term, but I wanted to give some ideas of what is going on now in oil. So in the first half, the market has been a little bit oversupplied. This is why oil price went down a little bit. But now, and this is why was this? Because the strategic releases from the US, the strategic reserve releases from the US and some other countries. Also, Iran, Venezuela, and Russia were pumping a bit more in the first half. But now, you know very well that OPEC has cut production and the market is moving to deficit. So if you do the maths with the elasticity, basically oil price should move to 90, 95. This was the calculation we made a couple of months ago, and it's already there, and probably going to 3 digits because we will see undersupply in the third quarter, in the fourth quarter, and the first quarter of next year. So short term, very optimistic, and long term, even more. Next slide. For me, this is the way to really understand the sector here is thinking what would have happened without shale oil. So shale oil brought 10 million barrels a day since 2011, and this is 10% of the global supply, right? And this came in 7-8 years, and now this is over because shales are plateauing. You can bring a bit more, a bit less, but it is plateauing. And we will need another 7-8 millions to 2030, as Carlos was mentioning. There's no another shale, so you have the same stories, like a little bit from Brazil, a little bit from Canada, a little bit from Guyana, but it's going to be very difficult to find another 10 million. This means that prices need to go high and incentivize new supply. And again, we have two problems: ESG and the fear of peak demand. As Carlos was mentioning, there's a big fear that demand will start going down structurally, which we don't think so. We don't agree. But this is stopping many people to invest in oil. Moving to copper in the next slide, 35. Well, the message here is even clear. If you see the chart on the black line, you see the EBITDA margin now in the industry, which is very big or very high versus historical. EBITDA almost at 70%, and exploration capex is not reacting. We are not exploring. We are not adding greenfields because it's extremely complex. You have ESG constraints, you have royalties and taxes constraints, you have permitting problems. It's really difficult to open a mine. 5 billion, 10 billion, 10 years in countries such as Congo or Peru. It is really difficult to bring new supply. And you can see in the next slide, one of the big producers in the world, Codelco in Chile. You can see in the chart how the production is fading and how the capex, which is the light blue, is going up every year. So they keep investing, production is going down. Why? Geology, grades are deteriorating, and lower grades mean higher cost and higher investment. And Chile, Codelco is struggling a little bit to grow. This is normal because it's old assets, so they've not been investing as they should have been, and this has an impact. And don't forget that Chile is like 1/3 of the production of the world. Basically, talking to people very knowledgeable, like Alberto Lavandeira in our Natural Resources Day, he said that the incentive price has to be more than $5 a pound. And now the price is 3.6. And with 3.6, these guys are making good margins. So, there's plenty of upside here in our numbers. There is supply for the next 2 years, and then there's a structural undersupply as from 2025, 2026. We'll see. Final word on salmon, because we are back, and we are back with the Classic and with the Natural Resources, and you can see here the consumption per capita of Norway. If you like to the red dot of Norway, which is 8 kilos per capita they consume, you can see that the Europeans will consume 3 or 4 kilos per capita, the US lower, but then if you go to the emerging markets, nobody really eats salmon. They can eat some fish, but there's huge potential here in terms of demand. So I wanted to put this as a source of optimism for the future, and supply will remain constrained with Norway and Chile struggling to grow. So conclusion, short term, the fund is fighting a bit with the macro, with the recession fear, commodities, blah, blah. And, the fear that the market has that China goes down. But longer term, nothing has changed. We are convinced of the super cycle. You see the summary here: oil growing demand until the end of the decade, probably the following decade also, with a lack of capex and supply. And for the green metals like copper or nickel, the demand will explode with electrification of the economy. So it's the call is even easier. Valuation, as we commented with the fund, is below mid-cycle. So it's very early still. We will invest below mid-cycle, and with the cash flow generation, we will benefit from this cash flow growth. So it's a very good moment to be there, even if there is a recession kind of fear, it will be short term. And, we think that this cycle will be much longer than the normal cycle because of the transition that, in our view, will take decades. So we are very optimistic here, and that's the message I wanted to pass. I think this is my last one. I hand over to Urs and his Natural Resources thoughts.
Thank you, Marcos. Want to have a few words and maybe also a bit the actual situation regarding this recession. Obviously, as we know, people are fearing recession, and therefore the typical thing is shorting commodities and cyclical industries. And here is a good chart of the global liquidity, and I have the impression the Western world still doesn't understand that it is not the main part of the world anymore. So they are always assuming what's happening in their countries is representative for the whole world. And as Carlos said, you know, we have a similar situation in many natural resources in terms of per capita consumption, meaning the economies in the emerging markets have a much higher delta on the demand of natural resources. And here you see the global liquidity, and the global liquidity did hit its low in autumn 22, which by the way was also the low in many markets. But we have not a constrained global liquidity anymore. And that's very different for the Western world. But obviously, if you look at and make an analogy from the liquidity in the Western world, it's more depending and has its effect on the local real estate markets, etc. But if you look at the global, for the demand for global products like commodities, one should also look at the global liquidity and not just at the liquidity of the ECB or the US. By the way, even when the Japan bubble burst, I think it was more than 20 years ago, the oil demand afterwards in Japan did not even decline. So it's questionable if this analogy with global liquidity has any impact really on some commodities. And as Carlos said, no, we have a record oil consumption this year of 103 million barrels. So I wouldn't be too negative because of this discussion. So maybe the next slide, Alex. We saw that people were extremely negative positioned in the second quarter here in the example of oil. So we never had such a negative sentiment in terms of people positioning themselves in the market in commodities. This was probably the best entry point in oil for the last 20 years, according to the sentiments and positioning. And obviously we see what's happening. People have to turn around and buy back their shorts. That's why the oil market or the oil prices usually, when this is such extreme, going the opposite way, what it does now. Maybe the next slide, Alex. And this is the stocks of the US, the strategic energy, crude oil and inventories. I mean, maybe we should take away the word strategic, because what strategic means, it shouldn't be an inventory to play around with the oil price, but it should be strategic for countering any supply issues. That's the reason it was invented in the 70s. So when Biden took office, it was nearly 700,000 barrels, a bit less. And now we are on the lowest level ever. And out of this less than 350 million barrels, I think 200 million barrels are sour crudes, which has a higher sulfur content than 0.5. And this is not great WTI or Brent trades. So 2/3 of the remaining inventory is not suitable anymore to sell on the market for depressing the oil price. So with the actual run rate, and the US is only selling sweet crude, I don't think it can last much longer, maybe 9 months, but afterwards, the whole sweet crude inventory of the US strategic reserve is gone. And then I think that's over. So we will have a limited time span how long this can continue. Maybe the next slide, Alex. And then I will come to this recession again. I have here the global steel market in 2022. The global steel market was declining around 4%. So this recession is already very old. And we see the actual countries. There were also countries which were growing, only two really from the big ones. It was India and Indonesia. And China steel production was not that horribly with -2%. But steel is a good proxy for the real economy because it's needed everywhere. So -4% last year. So this recession is ongoing since quite some time. And on the next slide, Alex, this is the inventory level of iron ore, and I have listed this because in commodities, following the inventory level is very difficult, because the more valuable a commodity becomes or is, the easier it is to have inventory. For example, looking at copper, visible copper stockpiles, often it has been vice versa than the truth. Meaning when the visible stockpile was low, the hidden inventories was high because everybody was afraid there are no inventories. But this is very different in iron ore, which I think is a good proxy for inventory levels to follow, because it's difficult to store. The only way to store iron ore is at importing ports, because the exporting countries like Australia, the mining industry is not storing produced iron ore, because it's not a complex way to mine, so they just cut back the production. So the visible inventories at ports in China, which is the 50% of the steel production, is a very good indicator. And you see that the peak in the inventories were already at the end of 21, and then it has been reduced massively. And this is the normal thing what in every industry happens. This is far ahead of financial markets and talking, because when you, for example, I don't know, a construction guy in China, and you see your sales are going down because the property market comes into a problem, then you reduce your inventory and you start consuming from your inventory. Then your suppliers is the same, and so on. So in a good market, it's like let's take a bakery. When the bakery expects to sell more bread tomorrow, he stocks up on flour inventories. So this is always ahead of the financial industry, and this inventory reduction, they were ongoing in the industry, in commodities, since nearly 2 years now. And the issue is that the impact is very big, and often it's exaggerated in terms of what people see. Because, a normal market, you would say, okay, the steel market is down 4%, so everybody buys 4% less coal and iron ore. But because of this inventory cycle, it has a much exaggerated effect, because when you start using up inventory, then you stop buying for a time span completely. So you might stop buying iron ore or copper or what is for 3 months, and then the figures look horrible, like minus 30% or 20% import figures. But the real end consume is down much less. So the summary is this recession in terms of inventory cycle is more or less discounted already. And if you look, for example, at iron ore prices, we are back in backwardation, and that's oil similarly. So we have already signs that the whole thing is strengthening and the inventories are cleared. Maybe the next slide, Alex. And then, just if you figure, this is steel. I mean, there's always good stories about fancy commodities, but if you look at the steel market or the cement market and all these not so fancy commodities, you see exactly similar figures like others. So meaning when we talk about infrastructure or electrification, all these kind of things, at the end you need everything, because if you build highway trains, you need copper and lithium, or for the cars lithium, but you also need these less fancy bulk commodities like cement or others which nobody talks about, and often have good profitabilities of the companies. Maybe the next slide, Alex. And then something to end, I found, which I think is quite a good analysis from Stiefel Research, and he compared our industry with the tobacco industry more than 20 years ago. Surprisingly, you see that the valuations are quite similarly, probably because obviously the interest rates are now very similar. But the tobacco industry was also believed to be toxic. Exactly the reasons what Carlos explained about the oil industry. Everybody believed nobody's going to smoke anymore, and you have to pay huge fines, which have been, by the way, already booked by the companies. And so nobody wanted to invest in this industry, and it was toxic. I remember one could buy a Philip Morris at piece of 5, similar valuations as the oil industry today. And everybody believed, it's ethically bad, and all these discussions like we have with ESG, particularly in oil. And on the next slide, the last one, Alex, you saw what happened with tobacco. It was one of the best things you could own for a very long time, because company gave back all the huge cash flows to shareholders in terms of dividend, share buybacks, etc. And nobody invested. So despite it was very profitable, no competition came in, because who would enter a tobacco industry when it's believed going down to zero? Exactly what Carlos explained about oil, which is exactly similar. And I think this is a very good analogy from Stiefel. And I think we are in an extremely comparable situation in our industry, particularly everything what is associated with carbon. So I would see quite a similar, and we already see a similar development, that all these companies are paying out a huge part of their cash flow, of their dividends, and now they are mostly debt-free, because that's what they did in the last 2-3 years, reducing the debt to virtually zero. So we can have similar developments for the next few years in our industries.
Hey, thanks a lot, Urs, Carlos, and Marcos. We have now time for a couple of questions. Actually, we have received already the question by email. That was actually, I would say, Marcos. The question was, what is our incentive price for oil?
Yeah, we've been using, historically we used 80. We did some numbers, and I would say that incentive price now is probably well above 80. If I had to say a figure now, is with inflation and the increasing cost that we've seen the past couple of years, I think is more close to 90 to 100 would be the number we would use now. But we have not updated already yet the number, so we are still using $85 Brent for our models, roughly speaking.
But with a clear risk of overshooting.
Yeah, I would like to add a line there. Incentive price means the price at which people are incentivized to invest. You can take an analytical approach, as we have done in the past, how much does it cost, what kind of profitability you need, cost of capital. But then you can take an empirical approach. Oil is now at 90 and nobody is investing. So that means the incentive price, by definition, is higher than that. Because at 90, people do not, some people are investing, but production capacity is still going down. So yeah, it is higher. Just empirically, people are not investing at these prices.
Yeah, it's very, very fair comment, Carlos. In the end, it's very difficult to put a number now because of the fear of peak demand. So as there is a big fear there that demand is going to peak in the next few years, and then the industry is really polluting, then there is a big question mark on what is the cost of capital now. What is really the return that a company or a board will ask in order to invest 5 billion in an oil field? Because historically, it was, in my memory, 15%, but maybe now it's 20 or 25. We don't know, because really risk apparently is super high. This means that incentive price could be even higher than this 90 to 100 I was saying. And very difficult to quantify because there's no modeling really.
And not mentioning any ESG impact or effects that hold back a lot of management.
That's what I wanted to say with the tobacco industry. One thing is the financials, but it's the narrative, like in the tobacco industry, that it's toxic, then people don't invest. It doesn't matter how good the economics are, because it's forbidden. And that's what the fact is for most of the big money. Pension funds, they're not allowed to invest in these things anymore. It doesn't matter how the profitability is.
There was another question for you, Marcos. Do we have some coal exposure?
Yeah, it's not very big. We have a company which is called Tech Resources. So Tech, and then we have Tech and we have Glencore. So I would say, summing up, both are 6-7% of the natural resources. They are not in the classic. So I'm talking only for the natural resources. So this 6-7%, half of it would be coal. So yeah, exposure is low. Prices now are high. It's not a commodity where we think there is a scarcity. So it's a commodity where we think there is enough reserves, resources, and supply. So we will buy more if coal, thermal coal and met coal, metallurgical coal, both prices go down, then the the companies will go down, then we can increase a little bit more, because we are more optimistic than other people regarding the coal future, both in thermal and in metallurgical.
Thanks. There was another question maybe for you, Urs. The writer was telling that everybody got burned quite a bit with commodity companies in the past, with mining and oil, with capital discipline. Now there seems to be capital discipline back in energy. Do we also expect that capital discipline in mining?
Yes, as Marcos showed, no, the capital discipline is here, and but of course in 10 years it might be different again. No, I mean this is the cycle, no, but you know this is taking time, and even if you would start investing today, you know that would not have an impact. And if you look at the historical capex, which was done then to really have oversupply again, and I think this is going to happen in 10, 15 years. But you know this figure must be higher today, you know, because you know for 10 years ago the mining industry multiplied their capex by 10 times. I mean this is amazing. From 07, you know, it was 10 times, and then it created an oversupply. But the next time it has to be much higher again, because obviously the costs have been rising. So you have you know, huge cost inflation. The same projects you would have had 10 years ago would cost now 50% more, and it's anyway getting more costly because, as Marcos say, geology, etc. So you know, for the next 5-10 years, I don't think it's a problem, and we are still only entering the effects of the capital discipline the last 10 years, because this has a big time lag, you know, Tallgoy comes into the production, you know, many of mining projects, they have been sanctioned 10 years ago and now are entering production. So this decade of underinvestment, this has just started because it has a time lag of 10 years. So we only starting to experience the effects of this decline in investments. But maybe in 15 years, yeah. So when you have just to go to like these fund fairs and look at fund like ours, when everybody manages billions and everybody wants to invest in commodities, then it's maybe time to get back to, I don't know, real estate or something else.
Perfect. We are actually just hitting the 1 hour time that we set ourselves. Thanks a lot for joining us, and feel free to contact us for any additional questions that you may have. I just see that there are another question was coming in. I will comment on that directly. Thanks a lot and have a great weekend afterwards. Bye-bye.